Good morning, everyone. Let the record show that we have a quorum, and I'd like to get started. First of all, let me apologize for being a little bit late, but between urgent constituent matters and the traffic, sometimes the journey from Northside to Boston to Georgetown can be long. But thank you all for coming. Today we're going to deal with the financial reporting of the Cayman Islands government, general report. I don't think we're on TV yet, so we need to find out what's going on with the system, whether we're live, delayed, or not on at all. Cockroach ain't got no business in a rooster fight. Huh? Huh? The TV's not on? No? All right, okay. Take your word for it. So, we're dealing this morning with the financial reporting of the Cayman Islands government, General Report 2015-2016, financial audits, and the consolidated accounts. We have with us Mr. Kenneth Jefferson, and we have his support staff, Mr. Matthew Tibbetts, hiding in the background. And I noticed I got on the same colored tie, but one is dressed in full black, so he can fade into the background, I believe. But anyway. Just a little bit of levity. So, Mr. Jefferson, you know the rules. You're here for all our meetings. The first question, the answer, just identify yourself so that the listening public will know who you are. And I'll open the floor up to questions from the members. Mr. Austin.
Thank you, Mr. Chairman. Good morning to the committee, and in particular, good morning to our witness this morning, starting off with the Financial Secretary, Mr. Kenneth Jefferson. First, let me congratulate the Financial Secretary and his team for a notable improvement on the public sector accounts. According to the Auditor General's report for the year ending 30th June 2016, 30 out of 36 entities received an unqualified or clean opinion. 6 were qualified, 1 adverse opinion, and 1 disclaimer. I think I speak for all in this committee when I say that I think that is a vast improvement when we consider just 4 years ago, over half of those entities received either a qualified, adverse, or disclaimed audit opinion. However, whilst we already congratulated those entities on a job well done, today we are here to focus on the shortcomings rather than the significant achievements. In terms of the qualified opinions by the Auditor General, 6 in total, some common themes highlighted throughout included matters relevant to completeness of revenue, property, plant, and equipment, and post-retirement healthcare liability. I want to, Mr. Chairman, focus on the largest of those 3, which of course deals with the post-retirement healthcare liability. In 2014, government's financial advisors estimated a post-healthcare liability of $1.18 billion. In 2017, that number jumped to $1.7 billion, or a 44% increase. While not mentioned in this Auditor General report in any significant degree, we must also consider, to give proper context to this conversation, the public sector pension fund, which is also unfunded to the tune of about $200 million. What this means, and I think we all agree, is that the costs related to healthcare coverage in and of itself has the ability to overwhelm the government budget if nothing is done to bring that under control. I don't think there's any argument there. So what's the answer? Some have said we in the Cayman Islands should be putting aside, in particular the government should be putting aside, $120 million each and every year to service this ever-expanding liability. But unfortunately, that's not what we're doing. Instead, a lot of people, both within the government and in the public sector, are all screaming of other ways we should be spending government surplus when in actual fact, more prudent savings are required. Mr. Jefferson, through you, Mr. Chairman, in February of last year, you said in the public domain that discussions with the Civil Service are expected to be concluded and a position reached with respect to the Civil Service cost sharing with government on their health care costs. I wonder, Mr. Jefferson, and through you, Mr. Chairman, if you can illuminate this committee on what those discussions may have yielded and what conclusions have been arrived at in respect to the often discussed civil servant healthcare costs, and in particular the concept of sharing those costs similar to what is operated in the private sector.
Thank you, Mr. Chairman, and good morning to you and all committee members and the clerk of the committee. My name is Kenneth Jefferson. Title is Financial Secretary and Chief Officer in the Ministry of Finance and Economic Development. Mr. Chairman, before I attempt to answer the question that the honourable member has just asked, I'll just put very briefly into context the matter on the discussion of the post-retirement healthcare costs. I'd start by saying that we have also commissioned now a valuation of that liability with an effective date of the 31st of December 2017. We have commissioned that to be calculated. I don't have the result as of right now, but it's on its way. Mr. Chairman, as the committee will know, at the end of June 2016, the liability number was approximately $1.4 billion. And to put that into perspective, the net assets of the government at the same date, the 30th of June 2016, without taking account of the 1.4 billion liability, the net assets of the government at 30th of June 16 were approximately $1.2 billion. So placing a 1.4 billion liability directly onto the government's balance sheet obviously has a tremendous impact on that balance sheet. I think the member Harris spoke about the 2017 valuation number, which was around 1.7 billion, would obviously have an even bigger impact. So the effect, just for the public's knowledge, the effect of putting the liability number squarely on the face of the balance sheet would turn the government's net asset position, which is quite strong now, of 1.2 billion, excluding the liability, would turn that into a negative position. And would say that the government does not, in fact, have any net assets, any positive net assets at all. And would, if it's even sensible to talk about it, the net assets position would be negative to the tune of, 200 million if you choose 1.4 billion and 1.2 billion in assets. If you choose 1.7 billion for the liability at the end of 17, the position would then be a negative 500 million. So it is extremely significant to try and put that into context. And I'd also make the point to say that, as we all know, the government is at the moment planning to incur borrowing in 2019 of, I think the appropriation approved is $153 million, and the other portion government would pay from its own cash resources to eliminate the debt in November 19. I just make the point to say that if you are a financier of the government and you had two contrasts, a balance sheet that says you have the government has positive net assets of 1.2 billion versus a balance sheet that says government has negative net assets of 500 million. The contrast is extremely stark. And one inspires great confidence to lend, the other one doesn't. So that's the context, Mr. Chairman and committee members. It's an extremely significant number. And I've said that we are in the process of getting a valuation number for the position at the end of December, 31st of December 2017. Haven't got that in hand yet. So finally, to get around to Mr. Member Harris' question about what the results of the discussions have yielded, what conclusions were reached as a result of those discussions. I have, Mr. Chairman, very limited knowledge of what those discussions were. All I can say, Mr. Chairman, is that it was concluded that the cost-sharing arrangements would not affect existing civil servants. It would only impact if the decision was made to have civil servants being hired at a specified date, and that date hasn't been specified. So if and when a date is specified, the cost-sharing arrangements would take effect in respect of civil servants hired beyond that date. I am very sorry that I don't have any more detailed information on that particular aspect, and I hate to sort of fend it off to another agency, but I think the portfolio of the civil service would perhaps have more information. I mean, I can obviously undertake to get information for the committee, but for now, all I do know is that it is intended that cost sharing would only apply to civil servants at a future higher date. And to the best of my knowledge, that higher date hasn't even been decided.
Okay. Just one follow-up question, if I may, Mr. Austin. Your evaluation that you commissioned, is that going to give you an annual liability or just a total liability projected?
Thank you, Mr. Chairman. It's actually going to do both. It's going to give us a liability as at the end of December 2017, and it's also going to say if the government were putting aside amounts annually to meet a future liability, what that annual cost will be. So it'll give us an annual cost, and it'll give us a liability number at a particular date that we specify.
But right now, each budget has within it various provisions to fund the health care of pensioners for that current budget in various votes, if I remember correctly.
Thank you, Mr. Chair. Yes, that's absolutely correct. So the budget that exists now and all past budgets have costs in it that relate to the likely expenditure to be incurred in that particular year. But I think the rationale and the thinking is the fact that you work a particular year, 2018, you are likely to incur healthcare costs during 2018, and therefore you need to make a budget to cover that. But the act of working during 2018, which is one more year of service, will increase the likelihood of future healthcare costs after retirement, and therefore you need to be accounting for that second part as well in 2018. And so that latter aspect of accounting yearly for what is a future benefit, we have not been including in our financial statements. It's essentially the current year likely costs that would be incurred during that year.
But unlike pensions, the coverage that you get is not related to the number of years that you serve. You just get, if you retire from the civil service, you get 100% coverage, whether you worked 5 years or 30 years, right?
Correct. The post-retirement coverage, healthcare coverage would kick in from retirement until the civil servant passes away. And in the calculations, and obviously the actuaries would have an estimated year at which a civil servant would pass away, and I'm sure that's in their 80s,
Yeah.
probably around 82, 83.
Average, yeah. The healthcare benefits are not protected. As I recall, the pension law says that the pension liability for government for the ensuing year carries priority in government budgeting. That hasn't been changed. Was the pension is the first charge on government revenue collected.
Not to my knowledge, Mr. Chairman. There are certain appropriations within the annual budgets that have some form of protection. It's rarely discussed, as you know, when the budget is presented here, because it's all put on the table for MLAs to look at and to discuss. But I think there are certain appropriations that are statutorily protected. I seem to recall some years ago that the remuneration of the Auditor General, for example, was one of those areas.
Thank you, Mr. Chairman. Through you, as a follow-up, thank you, Mr. Jefferson, for that answer. And if I can derive some thoughts on your answer, I wonder, is it fair to admit that where we stand today in 2018, we are no further ahead at finding a solution to the post-retirement healthcare liability than we have been in previous years? And is it fair to say, whilst you acknowledge you don't have the benefit of the discussions that took place within the civil service, I believe a memo from the Civil Service Association was published within the last year, where the civil servants flatly rejected the notion of cost sharing on the basis that their remuneration packages were based on having 100% of these healthcare costs shouldered by the government. And therefore, unless the government looks at increasing wages to compensate for these cost sharing, then the civil servants have, in no uncertain terms, outright refused the cost sharing initiative as it relates to post-retirement healthcare liability. Would that be correct, sir?
Thank you, Mr. Chairman. Mr. Chairman, yes, it's correct with respect to what the honourable member has said on the memo from the Civil Service Association. That is a correct position. Mr. Chairman, in respect of the earlier part of the member's question as to whether we are any further ahead now than we were a few years ago, I think the answer to that would be partially further ahead, partially because the matter is now in the public domain and it's fairly well known. We've had the healthcare evaluation reports tabled in the Legislative Assembly, so it's partly ahead in the sense that it's an open issue and it's well known. It has stalled to the extent of not getting it. So it is recognized within the notes to the government's financial statements as to what the liability is, the number. So it's there. It's simply not on the face of the balance sheet. And so the aspects that very little or no progress has been made on would be having it placed squarely on the face of the balance sheet, and perhaps even more importantly, little or no progress has been made as to how we actually tackle it. So you can recognize it, and it sits on your balance sheet, and it could actually grow from year to year. But how you actually tackle it in terms of getting it reduced, there's been, frankly and honestly, there's been no progress made on that, and no concrete, substantial progress apart from a thought about applying cost-sharing arrangements to civil servants joining the government after a certain date. And to be fairly honest and open, that applying healthcare cost-sharing arrangements to future civil servants is not going to do very much to the 1.7 billion liability figure.
Thank you, Mr. Chairman, through you. And I thank you for the latter part of your comment because it leads to what my question would be. If the civil service have stated and agreed that the cost sharing would not apply to existing civil servant members, but only those who are hired after any such date that decision is taken, as you quite rightly stated just moments ago, the incoming staff will not be such that they would even begin to make a dent in the costs or liability associated with the 1.7 or $1.4 billion liability. Also, I don't suspect anytime soon the government to engage in a hiring spree because it is as a result of that prudent financial management and a reduction in headcount and personnel costs that we see some of the positive numbers represented in the year-ending financial reports of 30th of June 2016. So the existing civil service have no solution for cost sharing. They agree that it may be acceptable for any new civil servants coming on board, but we also acknowledge those new civil servants coming on board will not make a dent in reducing the post-healthcare liability. So, frankly, it's not a solution at all. I will ask you, however, your opinion in terms of other viable solutions. Would you agree that in the absence of some other solution coming to the fore, that we have two options? Either as a country and as a government, we produce greater surplus budgets, save more, whether it be to the tune of $120 million a year, establish a fund specifically to cover the costs associated with that healthcare liability, or we lower the future healthcare costs to this country. Would those be the two viable solutions as we sit here today as being the most realistic?
Thank you, Mr. Chairman. And to the honourable member, thanks as well. Mr. Chairman, I just want to say some, before I get around to giving my opinion, just wanted to make it clear, and perhaps it might sound like a bit of backtracking, but it really isn't. What I would say in sort of defense for the government would be to say that, you know, we're obviously talking about huge numbers, $1.1+ billion in healthcare costs in the future, the potential for that to arise. I don't want the public to be left with the impression that this is a crisis. We are talking about the future. I am not in any way underestimating the significance of it, but we've obviously, excuse me, we've obviously have gone through many years of actually trying and testing situations where civil servants and their dependents have worked and retired and are now benefiting from healthcare service being provided to them and their families after they have reached retirement age, excuse me, without any hiccups in that process and without any crisis happening and without retired civil servants being told, I'm sorry that I can't give you the healthcare coverage that you have worked many years for. So I wanted just to say that although it is the idea is important and it's significant, we have obviously cared for, the government has cared for retired civil servants and their families all along without this becoming a national crisis. Mr. Chairman, in respect of the opinions that the honourable member just asked about, definitely it is the case, Mr. Chairman, that increasing surpluses and putting more monies aside is a solution. There's no doubt about that. Increasing surpluses could actually involve revenue increases, which in turn would either come from economic growth and leave existing rates and fees as is, or increasing rates and revenues and fee charges to the public, which I think the government or any government would try its very level best to avoid. So surpluses increasing with economic growth is the better option. Setting aside amounts annually to meet that liability in the future is great. And Mr. Chairman, bear in mind too that it is perhaps a kind of an academic exercise, because ultimately what we're saying is that if you were to put the liability number on the balance sheet today, it would be 1.4, 1.5 billion. There's no corresponding asset against which to attack that number. And what we all have in mind is that we're worried about that situation and the optics of it. What we would like to see is that there's an asset that's accumulating that can mitigate against the liability. And ultimately, we want the two to net to zero. But so the act of accumulating an asset to offset the liability, it is possible to argue that to some extent that's an academic exercise, because the real significant situation that's happening is retired civil servants are being cared for. That is important. So even though you have a huge liability number now, there's no adverse impact of that affecting persons being able to be cared for. And the real likely situation would be that in future years, the healthcare costs, people are living longer, etc. In future years, the government's budget is likely to show increasing health costs of providing for existing civil servants at the time and civil servants who have gone on to retirement. So the absolute number for healthcare costs in 15 years' time in an annual budget can be significantly, is likely to be significantly higher than that absolute number currently now in 2018. So that is a real prospect of occurring.
Right now, you take care of civil servants, retirees through allocation for costs, which is managed by Cynical, right?
Mm-hmm. Correct,
and
Mr. Chairman.
similar for active civil servants working. We have not yet gone and has any consideration been given to getting Cynical to quote a premium to civil service which covers the retirees and the healthy people. Because either of the two scenarios that you dealt with earlier, saving and putting money aside, and the likelihood or almost guarantee that healthcare costs is going to increase. All we need is 1 or 2 bad years and we are in serious financial problems for the government. But if the government addressed this under the mandated health insurance law and purchased health insurance for civil servants and retirees as a group, where the retirees got the benefit in premium of the younger and healthier civil servants, that has to be a more sustainable solution. And that would, in fact, wipe out the liability overnight. If you're then providing insurance coverage from today forward, the liability is gone because the insurance company has it then.
Thank you, Mr. Chairman. Mr. Chairman, and before I address your suggestion, I'd just like to say in respect of Member Harris' other request our own opinions. Another possibility would be a national health insurance scheme being
that's what we're talking
introduced
about.
in the Cayman Islands. So that's another possibility in addition to the surplus and so forth that he spoke about earlier. Mr. Chairman, I hope this is an answer to your question, to say that the premium rates that Cineco presently charges to the government are based on, they're in age bands. So an individual of 25 years as a civil servant attracts, I don't have, unfortunately, I don't have those rates with me, would attract a monthly premium rate of X dollars, and someone who's, 70 would attract a higher premium rate, which the government pays to Cineco.
But I would proffer that is self-defeating. That defeats the whole purpose of health insurance and spreading the risk. Because if you're valuing the risk of a 19-year-old and you're only charging a premium based on that risk, obviously the risk on somebody 59 is going to be substantially greater, and therefore if you value his premium for that age, that is going to be substantially higher. The whole idea of health insurance, and particularly group health insurance, is that you actuarially calculate a premium that covers all of the bands, and it is accepted that the younger ones are paying a little more to help look after the seniors, because the younger ones, one thing they're guaranteed, they get old too, right? So you are in fact paying forward for your own coverage when you become that age. It just doesn't make any sense for government to be paying an insurance company based on age bands.
Mr. Chairman, it's unusual. If I could ask a question for clarification, is it being suggested then that we should have one premium rate for everyone?
I've been suggesting that to government for the since. Well, I created the legislation in 1992 that would have done that, right? And I have been suggesting it since I came back in here in 2009, every year, that government should be insuring the civil service with Cineco on a premium that covers everybody. In fact, I would even suggest that putting in the indigents, because of the numerical difference in the number of indigents versus the number of healthy people, the adjustment for government might be positive in terms of what you're paying to Cineco, because Cineco, as a health insurance provider, has the ability that government doesn't have, is to reinsure for catastrophic illness in the open marketplace. And right now, government is not getting any of those benefits by allowing Cineco to price their insurance premium in age bands. Because when you get up, if you're only collecting at the top, and that's the only one that you're going to have any interest in laying off on a reinsurance market, the premium is going to be extremely high.
Sir, Mr. Chairman.
Thank you, Mr. Chairman. Mr.
Sir,
Chairman, if I...
Mr. Jefferson, sorry. We are looking at the government accounts, and in terms of the lack of sign-off or the adverse opinion from the Auditor General. The reality of it is that this is an accounting issue, and I think we have kind of gone a little bit far off, and there are other reasons, because we could be here all day speaking about healthcare. The reality of the situation is simply this, is that one, as the Financial Secretary said, there is no underlying asset. My issue is that we somehow forget that, one, the government also owns an hospital. So at the end of the day, the true cost to the government will be the incremental cost or the additional cost of carrying the people in the future. So that in itself must account for something. So that is one of the things we need to look at. If I have a garage and I say to my employees, I'm going to give you free mechanical service after you leave, at the end of the day, I still have the fixed cost of paying mechanics. So from that standpoint, the true cost would be if I have to go and buy or hire an additional mechanic just to service the people who work for me and have left. So from that standpoint, I mean, a $1.7 billion, it's the number just going to keep growing. Now, the issue is that, one, with the government now extending the retirement age from 60 to 65, it means then that the post-healthcare costs should actually go down and the current cost should stay up. And if government more moves to a voluntary and not make a mandatory retirement age where people are now living longer, because I refuse to believe that someone should start working at 65 when they're living to 82, and there's no way anyone is going to save up enough money within the civil service. Let's be honest. To live on a pension for 17 years, post what it is when you consider what the average salary is. So this in itself is a whole different exercise that we need to undertake in terms of looking at this. But I will say this much. In terms of expanding the old cynical issue, we have already determined in this House during the last budget session that the civil servants are actually subsidizing the retired people from the civil servants who now have cynical. So from that standpoint, so to put everything now squarely on the civil servants, I think is a little bit unfair. Now, just to bring it back to why we're here today, it is concerning the issues that why the Auditor General has issued opinion that she has, and I think we're kind of going a little bit too far off in the whole healthcare issue, so I just want to bring it back because my issue is more on the revaluation, and one thing that jumped out to me, and sorry, and this is where I'm getting to my question, was concerning the roads and the valuation of roads for $128 million. That I'm more concerned about in the sense of we have gone through, we have spent all of this money on roads, and now we're trying to evaluate, and those are the things. So I think I don't want to belabor the whole healthcare issue because that is a separate debate that has to be done in a different arena. So I just want to kind of bring it back before we get too far out.
Okay, well, you had any follow-up on the healthcare?
Well, yes, sir. Thank you, Mr. Chairman. Speaking on the need to secure stronger government surpluses, Mr. Jefferson, whilst, again, the previous administration must be applauded for their performance during the past 4 years, the financial statements, however, for 2014, 2015, 2015 to 2016 suggest that we may be arriving at a point of diminished returns in the sense that it's getting harder annually to secure surpluses. And this is evidenced in 2015 as reported by the Auditor General with reported losses to statutory authorities and government-owned companies of 46% in 2015 and a further 50% or half losses, reporting losses in 2016. Also, according to the Auditor General, these losses impact the cumulative annual surplus and are a result of the cumulative expenses growing at a more rapid pace than the cumulative revenues. To counter this, the Auditor General recommended that the SAGCs establish more robust audit and risk management committees, which they have done. However, the Auditor General noted a deficiency or an absence in core government in establishing these same mechanisms that oversee the progress of ministries and portfolios in terms of what is being done to manage risk. Basically, we are taking the SAGC's word rather than trusting but verifying. I wonder if Mr. Jefferson, the Honorable Financial Secretary, through you, Mr. Chairman, can tell us what is being done to address this deficiency within core government to improve risk management and the internal control frameworks in order to establish and safeguard public assets.
Thank you, Mr. Chairman, and thank Member Harris for his question. It's absolutely correct what the member has said in terms of the Audit and Risk Committee not being established as of right now in central government. I did speak to the Honorable Deputy Governor via email last night, yesterday evening, and this is a matter that has been put to his office, and he in turn have been liaising with Her Excellency the Governor, and the feedback that I've received is that we should be in a position to have the Risk and Audit Committee established by the end of next month, March 2018. I think it's perhaps one of the accomplishments that HE will make before she leaves office very soon next week, to actually have the committee up and running. I know that the last task was to actually get a person to chair the committee, and the efforts were being made to find that chairman from retired accountants. But I was told that the committee itself was going to be established no later than the 31st of March 2018. And would also make the point, Mr. Chairman, that this committee itself has obviously applied the right amount of pressure in seeking, and with the help of the Audit Office, to seeking improvements within the civil service and the wider public sector. So I hope that answers the member's question, that the committee will be established by 31st of March.
Thank you. Mr. Chairman, if I may take us back to, I believe, your question, sir, as it related to the Public Service Pension Fund. The 2014 actuarial valuation, which was finalized in 2015, approved by Cabinet in June 2016 and tabled in the Legislative Assembly, determined that a continuation of the current level of contributions to the defined contribution plan, which represents 12% of salaries, is projected to result in the depletion of the defined benefit allocated fund by 2024. The actuary also found that the parliamentarian plan is also severely underfunded, with current assets only covering 41% of past service obligations. Now, whilst I acknowledge that the Public Service Pension Fund is somewhat notably different than the post-healthcare liability, you did state that on the latter point that we are not in crisis mode and don't want to give the public the wrong impression. Well, when we look at the pension fund, once upon a time, 2024 may have seemed like a long way away. However, today it is a mere 6 years away. I wonder if the Financial Secretary, through you, Mr. Chairman, can tell this committee what plans, if any, are underway to address this funding deficit as it relates to the Public Service Pension Fund.
Thank you, Mr. Chairman. Mr. Chairman, thank the member for that question. The question of pensions, I think it perhaps it is a little confusing to the public in the sense that there's obviously a pension expense number which appears in our budget, but there's also a funding valuation that takes place every 3 years. Funding valuation meaning the amount of cash that the government would pay over to the pension fund in respect of pensions, and the two can actually be different. The previous funding valuation was in respect of the year, was in respect of the date, sorry, 1st of January 2014. The pensions law require that those valuations be done every 3 years. So there is now a valuation for 1st of January 2017, which will recommend contribution rates that the government has to pay over in respect of pensions to the pension board. I think the answer to the honourable member's question is the depletion by 2024 was on the basis of pension contribution rates existing at a certain point. If those contribution rates were to continue in the future, the fund would be, the defined benefit aspect of the public service pension fund could possibly be depleted by 2024. The purpose of the triannual, every 3-year evaluation is to look at those contribution rates to make sure that the contribution rates payable by the government to the pension fund does not cause a depletion to take place. So I said a lot, but I would conclude by saying that the 1st of January 17 valuation, which has been done, and it's to be presented to caucus and cabinet very shortly. That pension contribution rate does represent an increase on the contribution rate, the cash contribution payroll rates that was previously the case. So it is an ongoing situation to say that we do need to update our pension contribution rate so that the depletion does not take place, is my best answer, Mr. Chairman.
Through you, I keep, well, I keep asking this question, and for some reason I can't seem to get an answer. Can you tell us what percentage of the current civil service are on defined contribution versus defined benefits plan?
Thank you, Mr. Chairman. Mr. Chairman, in very approximate terms, and I can get precise information very quickly. The vast majority of civil servants are now on defined contribution pension plans. The percentage would have to be of the magnitude of 80+% are on defined contributions. The defined benefit, which is the more generous pension plan, relatively, in my example, 20%, relatively small and closed off, obviously, from the year 2000, so that the number of people can't increase. So it is of the magnitude of 80+% of civil servants are on defined contribution plans.
Right, and in the government's defined contribution plan, the basis of a defined contribution plan is that it is normally not defined the benefit that you will get, and it's not a lifetime benefit. It is only a benefit that is payable based on what your payout rate is until the money is done.
Correct, Mr. Chairman.
And in theory, under the defined contribution section of the government pension scheme, there's no liability to government.
Again, correct, sir.
Okay. What benefit, what amount is the 12% contribution now buying in a pension, either annually or monthly, for a civil servant?
Mr. Chairman, I'm very sorry, I would have to undertake to provide that information
Okay, because
to you.
the defined benefit contribution purchases a particular benefit,
Correct.
which is based on the number of years that you serve, right, with a maximum of 2/3 salary, irrespective of how many years you serve. I think you max out, what, about 30 years based on the contribution percentage that you pay?
Yeah, under the defined benefit scheme, a retired civil servant can get a pension that is equal to 2/3 of their salary. But to get that 2/3 maximum, you have to serve a number of years.
I think it's 33 years, something like that, right?
33 and a third years is the number that persons are most familiar with. But that 33 and a third years is linked to joining the civil service at a particular date. I think that might be around 1980. And so if you join the civil service prior to 1980 and you work 33 and a third years at the point at which you retired, you then are able to earn a pension equal to 2/3 of your salary. If you join the civil service after 1980, the period that you have to work to get the 2/3 maximum is 40 years. So someone like myself and Mr. Tibbetts
Which is the normal,
would have to work 40 years.
Yeah, normally in a defined benefits, your contribution rate should earn you 1/720th of your salary for each contribution that you make. Based on working 40 years out of a 60-year lifespan, you would then get 2/3 of your salary. The private sector legislation on defined contribution plans that mandates $1,000 a month, $12,000 a year, does not apply to the government contribution scheme.
No, Mr. Chairman.
Is there any legislation that sets that amount for government in a defined contribution scheme?
Not to my knowledge, Mr. Chairman. As you said earlier, on the defined in the public sector setting, the defined contribution plans specify that a recipient receives a pension on the basis of pension contributions made on their behalf from themselves and from their employer, essentially until that pot is finished. The pensions legislation do actually specify minimum, though. It does actually specify minimum monthly pensions. So in terms of raw calculations and maths, it could be that a person would ordinarily receive a defined contribution pension of $250 per month. But the law then specifies certain minimum levels, and I can't recall what those minimum levels are. So there are minimum monthly pension amounts specified in our pension legislation for the defined.
Right. In that case, when the minimums are higher than that which would be normally calculated, how is that funded? Is it the same money that is used that the person has, it just uses it up faster? Or does the government somehow make a contribution to make up the difference?
I believe that there are ex gratia payments made by the government to the pension fund to essentially cover the element that you were speaking of, Mr. Chairman.
Yeah, thank you, Mr. Chairman. Just through you, sir, I think for the reference to the public and that the government pretty much have, I think, under the defined benefit, there's a parliamentary plan, there's a judicial plan, and then there's a civil service plan.
You under your contribution?
Yeah, no, I'm talking that they operate, that they have. Okay.
don't have any more defined benefit for parliamentary.
No, but the plans that the government have, because if my memory serves me right, I think the last contribution rate was 16.3% for the general civil service, 30% for judicial, and 58.2% for the parliamentary plan that they operate. Now, I remember looking into those because at that point, the main issue was that the underlying assets weren't performing as they should have. Thus, the reason why the calculation, the percentage increase. My question to the financial secretary is this: of the defined contribution amount, is the government up to date in those payments? In terms of, is the government up to date in the defined contribution payments that they should be making?
Thank you, Mr. Chairman. Mr. Chairman, the answer to that would be yes. What I would clarify slightly to say that there is a 1st of January 17 valuation which recommends contribution rates being paid over to the pension fund that are different to what was in the 1st of January 14 valuation. And so I know that the contribution level will increase very shortly from the government to the pension board. And the member is correct. There are 3 plans: the judicial plan, the parliamentarian plan, and the main public service pension plan.
Are all the statutory authorities and government-owned companies members of the government pension plan, or are some of those involved in private sector arrangements?
Thank you, Mr. Chair. They're not all members of the public service pension plan. Not all of them. I would say a majority of them are. Like, if the committee is interested, I could get that list.
Ms. Austin, any more questions on pensions? Okay.
Sorry. My concern with the pension, and this is just a general statement. If you look at the average civil servant salary, which they say is around 3,000, and if you look at someone working for 40 years, you're looking at someone making just under $1.5 million, thereabouts. And if you look at 12% of that amount, you're looking at maybe about $175,000. And granted, you may have, I guess, it depends on how the assets are performing. And this has been the big issue, because in most cases right now, the markets aren't doing what they're supposed to be doing. So you're talking about a person, on average, maybe looking at $200,000 to $250,000 when they go to retire after 40 years of working, considering what the average is. And when you consider what their lifespan is now, the big question is this: we're going to recognize that there's a serious shortfall when it comes on to people living longer and what it is that they're setting aside. And I think this is one of the things that the government need to really start looking at, is in terms of moving away from this set kind of retirement date and make it something more voluntary. Now, I understand the limitation of this committee is that we more look at what it is that the government should be doing, as opposed to whatever, and not to directly get the policy. But I think at this standpoint, I think for the public and for the civil servants at large, this is a conversation that we need to have, where we recognize now, if we have civil servants after 40 years going out with $250,000 and they're living 17, 18, 20 years past retirement, the reality of it is that $250,000 is not going to go very far. And I think ultimately, us in this chamber, I think this is one of the issues that we will definitely have to tackle. So I just want to put that out there, because I don't want it to seem as if everything is hunky-dory running fast. It is still a bigger issue, especially moving to a defined contribution.
I think one of the most unfortunate things that happened to the civil service was they let the private sector convince them to shift from defined benefits to defined contribution. But that's behind us now. That's history. We have to live with it. Can I kind of take you down the Auditor General's report now and then, Mr. Jefferson? The Auditor General expressed some concern about the exclusion of the Public Service Pension Board. How are you addressing that? Is that going to be incorporated in the 2016-17 accounts, or?
Thank you, Mr. Chairman, and I'll try not to be too long in my explanation, but I do want to give the committee perspective. We did have just before the meeting started this morning, did have a chat with the audit office to clarify exactly what is meant, what they mean by their concerns. As we just heard, we have 3 pension plans, and the assets sit under the ownership of those pension plans. And just to put it into perspective, as of the end of December 17, the value of those investments, and of course it's based on market value, so they will change, but the value of those investments in the 3 plans was in the region of $823 million US. So the audit office is correct in that the assets are substantial and would have a substantial effect on the government's balance sheet if they were included. The Minister of Finance has taken a slightly different view and said that they should not be included because they don't really belong to the government. They belong to retirees and they belong to civil servants, etc. The conclusion of our discussion this morning was that we would need to pass legislation to make it abundantly clear that those assets belong to retirees and belong to active participants and do not belong to government. Mr. Chairman, we and members, we in the Ministry of Finance did make an attempt to get there by making a change in the Public Management and Finance law. I think it was in April 2017, where it was said that the financial statements of the pension board, which is the management of the three funds, the financial statements of the pension board shall not include the financial statements of the three plans. So we're trying to get away and put some separation there. But the answer to your question is we would need to make a change to the legislation, and probably the best place to do it would be the pensions legislation, to make that distinction as to say categorically who actually owns the fundamental significant underlying assets. Mr. Chairman, that would obviously only be possible for the 2018 financial statements and not the 16-17 financial statements that are now being prepared. We wouldn't have sufficient time to pass that legislation to make that impact on the 16-17 financials, but it can be done for the 2018 financial statements.
Okay. And then the next award would the inaccuracies in the opening balances and the adjustments. We know the history of that, but are we getting closer to having something, because this goes back obviously 3 years and we didn't have accounts as such, and the government at the day passed a law that we didn't need accounts for certain years, remember?
Mm-hmm. Thank you, Mr. Chairman. Yes, you're correct, Mr. Chairman, that the Public Management and Finance law was changed many years ago to say that financial statements only for the years ended the 30th of June 2009 onwards required auditing, and years prior to that didn't require it because at that point it was sort of too old and would lose their value. Mr. Chairman, not telling tales, but one of the most significant outstanding audits involves the Ministry of Education. So their audit for the year ended June 2014 has not been completed, and the year 15 and the year 16 has not been completed. And obviously with that agency having schools, etc., the amount of assets within that entity's financial statements would be significant and would have a significant impact on the entire public sector financial statements. Mr. Chairman, I can say to the committee that only, I think it was yesterday, there was an email from the Minister of Education to the Audit Office saying that the Minister of Education would be willing to accept whatever audit opinion the Audit Office would render on the June 14 accounts. And so I think that particular ministry for June 14 the conclusion of that audit will happen hopefully this month, early in March, but it could possibly happen this month. That would be a step forward because that one in particular is significant. We do keep, and this one has been long coming, we do keep pushing the issue. And I would say that also, sir, that the Minister of Finance, we have bi-weekly meetings with him in the Ministry of Finance, and we present a table to him showing the status of audits and which ones are outstanding, and he has been putting the appropriate amount of pressure on us to get the audits finalized, to get agencies who have any disagreements with the audit office to come to a conclusion and move on, because these are years old now.
I'm happy to hear that 2014 is likely to be done, but what about 15, 16? Is there any, has the Minister of Finance placed any deadline on the Minister of Education to get those accounts in some kind of order to be submitted and audited?
Mr. Chairman, through you, it's probably better for me to answer that than the Financial Secretary, given I've got responsibility for the audit. The issue is we've been trying to clear the remaining entity audits before we get into the 2-month period in March and April, when statutorily we have to do the 43 entities that have their financial statements for the 18-month period 16-17. Just to update you, we are virtually there and have as good as signed off on the Cabinet Office. We expect to be able to sign off on the Ministry of Home Affairs, the health side of Ministry of Home Affairs that was outstanding for 2015-16. And we're almost there with a couple of other entities. As the Financial Secretary said, the entity with a 3-year outstanding position is the Ministry of Education. It does feel that we're moving on there, and once we've done 2013-14, I hope the following 2 years will go a lot more quickly. Unfortunately, we will have to prioritise the 16-17 audits during March and April, so we won't be able to get back to them until May. But I do feel very confident that by the end of 2018, we will have caught up on the backlog, subject to then being no issues that we can't resolve with clients. We've moved a huge amount in the 18-month period to virtually eliminate the backlog, and I would recognise the support we've been given by the Financial Secretary and the Accountant General in achieving that.
Is there any rational explanation for this huge delay? Is it in any way related to the education portfolio moving around ministries every election, and the double accounting that would occur there? In other words, would education move in May last year, right? Is that going to complicate the progress?
Historically, there have been a number of issues, not least the valuation of assets that have caused problems. To be fair to the Ministry and its staff and my office, there will be different views on why there's a delay and what's caused and contributed to the delay. But I do feel we've been positive. We've reached a position where we'll be able to issue an opinion. Obviously, the outstanding ones are more problematic audits in terms of opinion in any event. I should say Cabinet Office will be a clean opinion, just to be clear on that. But it's unlikely, very unlikely that education will. So, of course, part of the discussions have been trying to... part of it is, of course, trying to give the client an opportunity to provide evidence so that we can remove qualification points. But I think we've exhausted those avenues now. But things will improve, and as we move through the latter 2 years for education, I hope we'll get to a better position in terms of qualification, but it's almost certainly going to be a heavily qualified account.
Okay. And is the other depreciation and amortizing expenses and accuracies also related to the delay in education ministry and stuff?
Yeah, it's very much related to the fact there's not consistent valuation across all of the PP&E, although the Accountant General, I must say, has done a fantastic job in getting a consistent valuation across many entities. We've still got some SAGCs that are on a different basis. And obviously, as you quite rightly mentioned, while we haven't got everything up to date and consolidated, that creates other issues too.
But the Public Authorities Law should now give the Minister of Finance and other ministers the authority to insist that they fall in line, the statutory authorities, and they use similar systems and so will allow for the... The question is, does the Public Authorities Law give you or somebody now the authority to insist that these statutory authorities and government-owned companies comply with government standards and follow similar processes?
Mr. Chairman, I'm not 100% certain of that. What I can say is that the Public Management and Finance Law itself, when it was last amended in April 17, one of the changes made then was to specify that the Financial Secretary shall be the overall leader of financial management and reporting functions. So we will use that lever, and I don't think that we will have a huge amount of resistance. At least I certainly don't hope so, in making suggestions as to what needs to occur. And the evaluation basis, Mr. Chairman, also will appear in the public finance manual, which the Treasury is issuing.
But and the lines of communication for that is clearly laid out in the Public Authorities Law, where you deal with the chairman of the board, and the board has to set the standards for the executive to carry out, right?
Correct, Mr. Chairman.
Sorry, Mr. Chairman, just looking back at the reason for the adverse opinion, I noticed one of the reasons it says incompleteness of evaluation, inconsistent accounting policies, and poor controls over property, plant, and equipment. I noticed the SAGCs was one entity that was also highlighted. Is it just one SAGC, or are there several SAGCs? And I would just like for clarification as to what, which one of the SAGCs are having those problems.
Thank you, Mr. Chairman. Mr. Chairman, I do know, in answer to the honourable member, that there are more than just one SAGC, that statutory authority and government company, for the benefit of the public, that has not valued their assets on a revalued basis and have stuck with the historical costs, the basis of valuing assets. Mr. Chairman, if I could ask the assistance of the audit office to, there is a specific paragraph within our appendix within the report that actually details out which particular statutory authorities would fall into this category.
It's paragraph 155 on page 60, I believe.
Thank you. So eight, Mr. Chairman.
Yeah, 8 entities.
Sorry, I have a different report I was looking at than I was actually going through the whole financial statement. Sorry. With regards, sorry, just to, okay, I'll take a look at that separately. I noticed also that one of the reasons for the adverse opinion was actually on the revenue side, incomplete revenues. Is it possible, I guess, maybe the audit office can probably give us more of a better background in terms of what those issues were with regards to the incomplete revenues, just for the benefit of the listening public.
Thank you, Honourable Member, through you, Mr. Chairman. It was particularly on the coercive revenue side. So within the entire public sector, you have all of the coercive revenue, which is revenue which has no sort of direct service attached to it, which the government of state has the opportunity to levy. That falls under direct ministerial responsibility and is kept set outside of the individual ministries that that we audit. So the only place at which we look at the executive level income is actually through the entire public sector accounts. And again, the Financial Secretary may wish to say more, but management can't attest to the controls around that coercive revenue to assure us of its completeness. And of course, we know that there are system improvements going on in customs, for example, at the moment to try and address some of those issues. And we have, through our previous audit report in 2015, look at the collection of government revenues. But until we get proper systematic controls on the coercive taxable revenue of government, that qualification will remain. In addition, you do have issues where some individual entities have got revenue completeness issues, and indeed tomorrow the 3 sessions where you'll be talking to the museum, the gallery and CNCF, that there's issues around revenue completeness there. And of course the most significant one, which is material at the EPS level, is the Health Services Authority and the problems they've got with their revenue collection, which this committee has sort of heard sessions on many a time.
Thank you for that clarification. Sorry, just going back to my previous question, sorry. The page in which you directed shows us what entities were included for the consolidated financial statements. What I'm looking for is basically which one of the SAGCs was the culprit. So I know the HSAs was one of them. Are there others that, in terms of the whole revaluation exercise, that also caused the audit, for cause of the adverse opinion outside of the HSA?
Sorry, through you, Mr. Chairman, I missed that. Are you still talking about revenue or something? The revaluation?
Mr. Chair, if I may, there are 5 statutory authorities and government companies that actually stuck with what is called the cost valuation method versus the fair value. And those are the Civil Aviation Authority, the CNCF, the Turtle Farm, the National Gallery, and the Water Authority. So we conducted a service-wide evaluation, but some have chosen to stick with the costing method. And this year we are ensuring that everyone moves to what is called the fair value method of evaluation.
Okay, thank you very much for that. Just for my own edification now, because 2 weeks ago, thereabouts, we were here and some of those entities got clean audit opinions. So I'm trying to figure out then if they were clean audit opinion on the individual level, why then is there an issue at the EPS level, at the entire public sector level?
Thank you for that question. Either of us can answer this, but I'm familiar with it, so that's why I was thinking I could just answer it. So at an individual level, obviously they wouldn't have an issue because individually they weren't told they had to do it this way, and they're allowed to do either method, cost or fair value. However, when we consolidate it, it creates an inconsistency across the board. So then audit then qualifies the consolidated accounts because some are valuing on fair value, and some are valuing based on cost. So the inconsistency is where the qualification comes from.
And I'm assuming you guys are going to fix it because ultimately what it is that we're looking for is how can we get a clean audit opinion for the government? No. In the past, I was under the impression that it was more the pension and the healthcare issue that is the primary drive was behind. But no, when I'm seeing these other issues, and especially when looking at coercive revenues, I can tell you, taking, for example, charitable organizations, I don't think there's probably any charitable organization in Cayman that has a clean audit opinion because everyone basically gives that qualified based on the revenue issue. If that is the case, on the government side, at some point, materiality has to kick in where whatever the coercive revenue is or the amount is, it has got to be immaterial to at least give a clean audit. But what we don't want is to say that we have structural issues that will forever prevent us getting a clean audit. So the main thing then is like, what is it do we ultimately need to ensure that is fixed, that within the next 2-3 years we can say the government now has a complete clean audit?
There are a number of things that we need to address still. We started out by working on the fixed assets and real property, including the road network as well. We didn't get it 100% the first year, which is why we still have some issues identified here, where we could have had the authorities, we should have maybe given specific direction to say you need to have fair value, method of valuation. So we're still it's a work in progress for sure. But in regards to the revenue, course of revenue particularly, we have a situation in government where the entire public sector reporting unit is consolidating accounts. Realistically, the job of the EPS unit is to consolidate accounts, not so much focus on developing a framework and so on. Now, that's something the Ministry of Finance needs to work on maybe in regards to a framework overall. But we have a situation where each ministry is collecting course of revenue individually. But the audit is actually conducted at the entity level. So there's two different layers in each ministry. We have an executive level, which is the overall, the executive level is the overall ministry finances, and then they have an entity level, which is responsibility of the chief officer and operations of the ministry. Audits are currently conducted at the entity level, which means we can get a clean opinion on the entity level. Now, that doesn't mean that their course of revenue that they collect is then accurate and so on, and complete and so on. So we have a situation where a ministry is getting a clean opinion, but for a portion of their books, essentially, which is considered the entity level. So something we're looking at doing to address this is considering, we'd considered a few different options in the past. One of them was potentially merging executive and entity books together so that actually be responsible for the entire ministry books. Something we're considering now, which would be a quicker change and would probably be a more appropriate change, would be auditing, considering whether we should be auditing at the executive level, because that would then include both the entity and the executive. Now, we don't want a situation, obviously, where everyone's getting a clean opinion now. Because we change where we're auditing, everyone now gets a poor opinion, a qualified opinion, adverse, or disclaimer even. So we want to ensure that we work with CFOs in the current year to try to get their executive books to a position where they'll end up with a clean opinion as well on the overall ministry books and not just for the entity level. I would rather a situation where when we transition to auditing at a different point, they remain at a clean opinion or an unqualified opinion, so that we don't have a situation where it appears to the public that we're going backwards and having clean opinions previously, now we have qualified accounts. So it's something that we're trying to manage and work with CFOs to ensure that we actually get to that point where they can get clean opinions on the entire ministry accounts.
Mr. Chairman, if I take a few seconds to elaborate, because I think it might be a little confusing and not clear. When yourself and the Deputy Governor were handing out acknowledgements of clean opinions, etc., I just wanted to spend a few seconds on that. The individual ministries' portfolios, offices, accounts on which opinions are rendered and which they receive the certificates for. When you look at their financial statements, the revenues there that are recorded there and on which the opinion, the audit opinion is issued, and the expenses there on which the audit opinion is issued, the revenues there relate to the relationship between the ministry, portfolio, office, and cabinet. So the Ministry of Health will show revenue received from the cabinet for the production of outputs. If you move to the Ministry of Education, which now includes lands, and you look at their entity financial statements, their revenue line is going to be dominated by revenue that they get from the cabinet for producing outputs that the cabinet wants. You won't find, in that example, you won't find stamp duty as part of the Ministry of Lands revenue. You won't find, so these so-called, these termed coercive revenues don't appear within the individual entity's financial statements. It's the relationship between them and the cabinet. So in the case of finance, we won't find customs import duties within Ministry of Finance accounts. What CFOs and chief officers focus on is to get an unqualified, clean opinion on their own individual entity. And so the coercive revenue aspect isn't recorded in those individual financial statements. They're not in there, and they're, and to be blunt, sir, and to the committee, we in finance do not believe that the same level of care for accounting for executive transactions exist
Yeah.
as the same level of care for the entity transactions, because the individual ministries want to get a clean opinion on their entity finances. So one of the thought processes that we have is to say that, for example, Ministry of Lands, you shall be made responsible for coercive revenue in the form of stamp duty. Ministry of Finance, you shall be made responsible for coercive revenue in the form of import duties, and then also require an opinion to be rendered on whether those executive transactions, coercive revenues, are valid. And we believe that because that is likely to be problematic, the individual CFO in all of the different agencies will want to endeavor to improve the level of care and accounting for those transactions, to get a clean opinion there too. And in that process, then that helps the entire public sector.
Makes sense. Yeah, makes sense.
Mr. Chairman, to the Accountant General, Mr. Eubanks, just taking it back to Mr. Tibbetts, excuse me, taking us back to the question relevant to the National Museum and the Auditor General's observance of some concerns regarding the completeness of revenue, which again, I understand as the question was answered, it relates to the manner in which those entities operate, particularly to cash donations, which may not necessarily subscribe to, the standard practices or accepted practices of the entire public sector. But the Auditor General also noted the inability to offer an opinion when it related to property, plant, and equipment. And these things, maybe I just need an explanation, but as I see property, plant, and equipment, these are fixed assets, not cash donations that may somehow operate differently on the revenue side. Perhaps you can explain to this committee, through you, Mr. Chairman, where the deficiencies lie in valuating the property and other fixed assets of the National Museum.
Tomorrow. That'll be it. Perhaps I could help with that. I think that may be a question better directed at the museum tomorrow, because that's an entity level issue that the Accountant General wouldn't be involved with. And obviously the revenue points I made with regard to the 3 sessions tomorrow, they're relevant for the qualification on the entity, but they're absolutely immaterial for the position on the entire public sector because they're so small.
Okay. Any other questions? If not, Mr. Jefferson, thank you very much, sir. And it was a pleasure to have you as a witness, sir.
Thank you, Mr. Chairman, and thank honorable members of the committee as well.
We'll take a break and come back at 11 for the